There's a ritual that happens inside old money families that almost never gets photographed, never gets leaked, and never makes it into a magazine profile. It doesn't happen at a wedding or a funeral. It happens at a conference table, usually in a nondescript office building with no nameplate on the door, and it happens roughly once every 10 years. The family calls it different things depending on which dynasty you're talking about. Some call it the review. Some call it the reset. One European family office we'll examine later in this episode calls it bluntly the audit. Whatever the name, the function is identical. Every decade, the senior generation sits down with lawyers, security consultants, reputation strategists, and financial advisors, and they systematically interrogate their own lives, not their portfolio. Not just their portfolio, anyway. Their exposure. Who knows where they live? Who has access to their children's schools? What their digital footprint looks like to a private investigator, a kidnapper, a tabloid, or a plaintiff's attorney. Whether the trust structure built in 2016 still makes sense under 2026 law. Whether a cousin's Instagram account is quietly leaking the location of a family compound. This is not paranoia. This is maintenance. And it is one of the least discussed, most consistently practiced disciplines in generational wealth, because unlike a stock portfolio, a life's worth of exposure doesn't rebalance itself. Here's what's genuinely strange when you study this pattern. The families who do this well are almost never the families you'd recognize. The visible ultra-wealthy, the ones with public foundations, splashy real estate, a recognizable surname, are frequently the worst at it, because visibility itself is the vulnerability they've already accepted as a cost of doing business. The families who've held wealth the longest, across 5, 6, 7 generations, are disproportionately the ones nobody outside a small circle of advisors could name. That is not an accident. That is the audit working. Today we're going inside that room, not with speculation, with the actual mechanics, the checklists, the frameworks, the professions, built specifically to run these reviews, and 2 case studies of what happens when a family skips the audit for too long. One preserved a 4-generation fortune through 2 world wars by doing exactly this. The other lost control of a household name because they didn't. This isn't hidden. It's just never taught. Let's get into it. If you've ever wondered why some families with money you've never heard of are still standing after 200 years, while public dynasties implode in a generation, subscribe now, because the next 7 sections are the actual mechanism, not the myth. Why every decade the logic of the interval. 10 years isn't arbitrary. It's the rough half-life of 3 things that decay simultaneously in a family's risk profile: legal relevance, digital footprint, and generational transition. Legal decay, estate law, tax law, and trust law shift on political cycles. A trust structure built to be optimal under one tax regime can become suboptimal, or in rare cases actively hazardous, a decade later. Family office literature on multi-generational wealth planning consistently flags that documents drafted more than 10 years prior are treated as presumptively stale, not because the drafting was bad, but because the legal environment they were built for no longer exists. Generation-skipping trust rules, state residency tax treatment, and international reporting requirements, think FATCA-style regimes, have all changed meaningfully more than once since 2000. A family that set its structure in 2010 and never revisited it is often operating on an outdated map. Digital decay. This is the newer, faster-moving front. A decade ago, geotagged photos, home security footage leaks, and children's school social media accounts weren't meaningful attack surfaces. Today, they are the primary ones. Executive protection firms that serve ultra-high net worth families report that the majority of physical security breaches, stalking, unwanted approaches, in a smaller number of cases actual intrusion attempts, originate from digital footprint failures, not physical security failures. A gate and a guard don't help if a teenager's public location tag told a stranger exactly which private airport the family flies out of every August. Generational decay. Every 10 years, roughly, a new cohort of family members reaches an age where they hold information, access, or public visibility they didn't have before. A teenager gets a driver's license and a car with a traceable plate. A young adult starts a company and has to file public paperwork. An in-law joins the family and brings their own, unaudited digital history with them. Each new person is a new vulnerability the existing audit didn't originally account for. Put those three decay curves together, and you get a fairly precise argument for why every decade isn't superstition. It's closer to an actuarial standard, similar to why buildings get structural inspections on a schedule rather than only after something visibly cracks. One useful way to think about it, a stealth wealth audit is not a single event. It's 5 parallel sub-audits running on the same 10-year clock. Let's go through each one, because this is where the actual substance of the episode lives. The legal and structural audit. This is the audit most people assume is the whole thing, and it's actually just 1/5 of it. Family offices that manage multi-generational wealth typically run what's internally called a structure review, a full re-examination of every trust, holding company, foundation, and legal entity the family uses, checked against current law, current family composition, and current asset mix. The review usually asks 4 questions. 1. Does the structure still match the family? A trust built for 2 beneficiaries doesn't automatically work cleanly for 8 grandchildren with different countries of residence, different marriages, and different risk profiles. Family constitutions, the internal governance documents we covered in an earlier video, typically get revisited on this same cycle for exactly this reason. 2. Does the structure still match the law? Jurisdictional arbitrage, using specific states or countries with favorable trust law, is a real and legal practice. But the favorable jurisdiction of one decade isn't guaranteed to remain favorable. South Dakota, Delaware, and Nevada have each, at different points, been the preferred domestic trust jurisdiction in the U.S. as their statutes evolved. A family that set up in one jurisdiction in 2008 may find a decade later that a competing jurisdiction now offers materially better asset protection or privacy statutes. 3. Does the structure still match the asset mix? A trust built around a single operating business looks very different once that business has been sold, and the assets are now diversified across public equities, real estate, and private credit. Failing to update entity structure after a major liquidity event is one of the most commonly cited errors in family office postmortems. 4. Is anything now unnecessarily exposed? This is the part people miss. Some entities that made sense to hold in a family member's own name a decade ago, a car, a piece of art, a smaller property, often get moved into an LLC or trust wrapper specifically to remove the family member's name from public property records and litigation exposure. Real estate held in an individual's name is discoverable in a basic public record search in most U.S. counties. The same property held through a properly structured LLC is not, without considerably more work. The digital footprint audit. This is the newest of the 5 sub-audits, and the one growing fastest in importance, because it's the one most families' own children are actively working against without realizing it. A digital footprint audit for a wealthy family typically covers geolocation leakage, photos posted by anyone in the family, including staff, tutors, and friends of children, can carry embedded metadata or visible background details. A street sign, a distinctive property feature, a school crest, that map directly to a real-world location. Reputation and security firms serving this demographic routinely run reverse image and metadata sweeps across every platform a family member uses, including accounts belonging to people adjacent to the family, a nanny, a personal trainer, a school friend, because those accounts are frequently less careful. Property records and permit filings. In much of the US and UK, property purchases, renovation permits, and even some utility hookups generate public records. A meaningful chunk of de-anonymizing work that journalists and, less benignly, stalkers or process servers do starts here rather than with anything the family posted themselves. School and extracurricular visibility. Private schools, sports leagues, and university acceptance lists sometimes publish names in newsletters, yearbooks, or press releases without the family's direct control. Part of the audit is contacting these institutions proactively to request name omission or use of initials, a request that well-resourced families make routinely and that most institutions accommodate without friction once asked. Household staff and vendor discretion. Non-disclosure agreements with staff are standard, but the audit checks whether those NDAs are current, whether new vendors, caterers, event planners, contractors have signed equivalent agreements, and whether any former staff have public social media referencing their old employer. The Google test, a simple but telling exercise. Search every adult and child, family member's full name, plus common nickname variants, plus the family's known properties, and see what surfaces. Family offices often run this exercise themselves before hiring an outside digital risk firm, precisely because it's the same first move an outside party, a journalist, a competitor, a hostile ex-spouse's lawyer would make. The pattern worth naming clearly, none of this requires the family to have done anything wrong. It's not scandal management. It's the digital equivalent of checking that all the doors are locked. A maintenance task, not a crisis response. Try that Google test on your own name later today. You'll be surprised what surfaces. And if this kind of mechanism-first breakdown is useful to you, drop a comment with which sub-audit surprised you most. It genuinely shapes which topic we go deep on next. The financial exposure audit. This sub-audit is closer to what people expect from an audit in the traditional sense, but it's broader than a portfolio review. Spending and lifestyle creep. Family offices track whether a branch of the family has quietly increased its draw from shared trusts or entities over the past decade, not usually out of suspicion of wrongdoing, but because unaddressed lifestyle creep in one branch is one of the most common sources of resentment and eventual family conflict. This connects directly to the black sheep and incentive trust dynamics we've covered before. A decade review is often the moment a family catches a drift before it turns into the kind of dispute that ends up in court, or worse, in the press. Liability and insurance review. Umbrella liability policies, art and collectibles coverage, cyber liability coverage, and kidnap and ransom insurance, a real and fairly common instrument among ultra-high net worth families, typically structured so that its very existence is confidential even to the insured family member's extended circle, all get re-underwritten. Asset values change, property values change, and a policy sized for a decade-old asset base can leave a meaningful gap. Counterparty and advisor exposure. Who has signing authority? Who has access to the family's financial data? Whether any advisor relationship has gone stale, meaning the advisor no longer has a peer relationship with the family's current generation, only a legacy relationship with the previous one. Family offices frequently use the decade mark to formally test advisors, requesting competing proposals from outside firms, not necessarily to switch, but to confirm the existing relationship still reflects market terms and current best practice. Debt structure review. Families that use the buy, borrow, die strategy, borrowing against appreciated assets rather than selling them to avoid triggering capital gains, periodically re-examine loan-to-value ratios, interest rate exposure, and whether the borrowing structure still makes sense given current rates and asset performance. A structure that was cheap and low risk in a low-interest rate decade can become considerably more expensive to service in a higher rate one, and families that don't revisit the math on schedule can find themselves over-leveraged without ever having made a single new, irresponsible decision. The ground simply moved under a static plan. The reputational and network audit. This is the sub-audit most connected to the social network topics we've covered previously, and it's where the vetting their own lives framing becomes most literal. Families with multi-generational visibility, even families that actively prefer obscurity, periodically review who speaks for the family. Is there a single, current, agreed-upon position on what gets said publicly, and who is authorized to say it? Family constitutions frequently include a communications clause specifically because an uncoordinated relative giving an off-the-cuff interview has historically been one of the more common sources of reputational damage. Not scandal, just inconsistency, contradiction, or an unintentionally revealing comment. Board and affiliation review. Which boards, charities, clubs, and institutions carry the family name or a family member's public affiliation, and whether each of those affiliations still reflects well on the family a decade later. Institutions change leadership, get entangled in controversies, or simply drift from the values that made the original affiliation sensible. Old money families with genuine longevity are notably disciplined about resigning from affiliations quietly, well before any controversy, rather than waiting to be associated with one. Network health check. This connects to a genuine mechanism worth naming plainly. Sustained access to the right rooms, certain clubs, certain boards, certain marriages, functions like a maintained asset. Families audit whether their existing network still opens the doors it used to, whether relationships have atrophied through simple neglect, and whether the next generation has been properly introduced into the network before the older generation that built those relationships ages out of them. A network built by one generation and never actively transferred to the next is functionally a network that expires with its builder. Press and archive review. A search of the family's own historical press coverage, checking for outdated, inaccurate, or since-resolved stories that still rank prominently in search results, and in some cases working with reputation management firms to ensure accurate current information is what surfaces first. This is standard, legal, and widely used. It is not the same thing as suppressing true information, which reputable firms in this space decline to do, and which carries its own legal and ethical risks. The heir readiness audit. The final sub-audit is the most human of the five, and it's the one most connected to a family's long-term survival rather than its immediate security. Every decade, roughly, brings a new cohort of family members into legal adulthood, financial responsibility, or public visibility. The heir readiness audit asks, do they know what they're walking into? This connects directly to the silent rules heirs learn before 18 material we've covered previously. The decade audit is often the formal checkpoint where a family confirms those informal lessons actually landed rather than assuming they did. Do they understand their own exposure? A 19-year-old with a large trust distribution coming at 25 has a different risk profile than they did at 15. Different social circles, different romantic relationships that may eventually involve prenuptial considerations, different visibility through their own social media use, different capacity to be targeted by advisors or acquaintances with their own financial interest in getting close to them. Have they been briefed, not just protected? A recurring theme across family governance literature. The families who do this well don't just shield young heirs from information. They brief them, walking a 22-year-old through exactly why the family holds property in trust structures, why NDAs exist for staff, why certain topics aren't discussed outside the family, and why lifestyle choices that seem private are, in practice, part of a shared risk pool. The stewardship versus ownership framework we've discussed before is essentially taught formally during this stage of the audit. This is also often when a family decides whether a given heir is ready for more visibility and responsibility, or whether more time and mentorship is needed first. A decision made deliberately, on a schedule, rather than by default or crisis. This is usually the part of the process families wish they'd started earlier. If you want the full breakdown of how old money families actually prepare heirs before 18, that companion video is linked in the description. Go watch that next, because this section only makes full sense alongside it. 2 families, 2 outcomes. To make all 5 of these sub-audits concrete, here are 2 illustrative composites drawn from documented patterns in family office and dynastic wealth history. The individuals are fictionalized composites, not real named persons, but the mechanisms are drawn directly from the documented historical record. The family that did it, a European banking dynasty, 19th to 20th century, facing 2 continental wars, currency collapses, and multiple changes of government within a single century. One prominent European banking family survived where many contemporaries didn't, in significant part because of a documented practice of periodic, deliberate restructuring, moving assets across jurisdictions, formalizing family governance early, and maintaining rigorous discretion about the family's total holdings, even from some of its own extended members. Historical accounts of the family's operations describe a level of internal compartmentalization and structural adaptability that reads, in modern terms, almost exactly like a stealth wealth audit, practiced without the modern vocabulary for it. The family's continued prominence across multiple centuries through regime changes that destroyed comparable fortunes is the empirical result. The family that didn't, a mid-20th century fashion house, composite case. A well-known design house, call it, for this composite Maison Verdier, built enormous brand equity around a single visible family name across 2 generations. The family's 3rd generation inherited both the business and its visibility, without a corresponding update to the family's legal structure, digital exposure, or governance clarity. A public and prolonged family dispute over control, playing out substantially in press coverage rather than in private governance, damaged the brand's value considerably before an outside investment group ultimately took a controlling stake and the family's operational involvement ended. The mechanism failure here wasn't a single bad decision. It was the absence of a scheduled review that would have surfaced the governance gap, the outdated legal structure, and the reputational exposure before a crisis forced the issue into public view instead. The pattern across both cases. Audits don't prevent every possible bad outcome, and families that skip them don't automatically fail. But the base rate difference between families with a disciplined scheduled review practice and families operating on legacy structures set decades earlier is stark and well documented across family office literature and multi-generational wealth studies, which is precisely why this practice, quiet and undramatic as it is, has persisted across the families that have actually lasted. If you want the deep dive on exactly how family governance meetings are structured, the actual agenda, the actual documents, that's the companion video linked on screen now. It's the natural next step after understanding why the audit exists. Here's the through line across all 5 sub-audits. None of them are about secrecy for its own sake, and none of them are reactive. They're scheduled maintenance for a life that has more attack surface than most people's, run on a cadence disciplined enough to catch problems before they become public ones. The families who've held wealth the longest aren't the ones who got lucky and avoided every crisis. They're the ones who built a habit of checking every 10 years, whether their legal structure, their digital footprint, their financial exposure, their reputation, and their heirs were all still correctly calibrated to the world as it actually was, not the world as it was when the last plan was made. This isn't hidden, it's just never taught. And now you know the actual mechanism behind one of the quietest, most consistently practiced habits in generational wealth. If this series is genuinely teaching you something you can't find anywhere else, the single most useful thing you can do is subscribe and turn on notifications. We're covering the full decade-by-decade family constitution process next, and you won't want to miss how these pieces connect. See you in the next one.